Good evening, guys. Happy Tuesday night. Todd Sachs of Sachs Realty. I'm the broker and founder here. This is our second episode of Tuesday Night Live, where we talk about anything and everything real estate. And tonight we're going to talk about mortgage forbearance. And it's a really important topic right now because you see the CARES Act, something that was protecting borrowers of government backed mortgages, which is a huge percentage of the loans in America, basically was expiring last night. So it has been extended, and we're going to talk about what forbearance really is. We're going to talk about some of the outlooks. We're going to discuss what we were all thinking in March when this whole thing was just imploding and exploding, and COVID-19 was, quite frankly, scaring the living daylights out of everybody. And tonight, I'm honored that I have a special guest. He's a friend of mine and another local business person here in Maryland. His name is David Thurston, and he's the owner and attorney of Crown Title. And Dave has been doing this stuff for a very long time. He is an expert. You're about to hear from him. He's an expert in foreclosures and forbearance, something foreclosures we want to stay away from. But we're going to talk about how the numbers are showing that things are actually better than many of the experts had predicted. So Todd Sachs again, Sachs Realty. I'm the broker and founder here. We are really, we're a boutique brokerage here in Maryland. We're help buyers and sellers of both residential and commercial real estate. And we've got a great reputation of doing so. I love bringing you value, regardless of whether you're a client or not. And if you're watching this on YouTube, please take a minute to subscribe to our channel and hit that bell so you get an alert every time we post great content like this. Also, if you're watching us on Facebook, if you would like our Facebook page, that would be great. And drop us a comment. We will take your questions tonight. We have Melissa on deck, and Melissa is going to be looking at your comments on the social media platforms. And we're going to try and get those questions answered for you tonight. If you're in another state other than Maryland, we have a broker network program all over the country. I can help you if you're buying or selling, or leasing, whatever it is. You drop me your information. You can also email me at TS for Todd Sachs, TS at SachsRealty.com. Now, without further ado, I'd like to introduce to you Dave Thurston. Dave, thank you so much for joining us tonight. If you could tell our audience a little bit about you.
Thanks for having me, Todd. As you said, I'm a real estate attorney here locally. I've been a real estate attorney for close to 30 years. I'm a member of the Maryland, D.C., and New York Bar, and I have a large title company that's licensed in about 30 states nationally. And we've done a lot of foreclosure workout tasks for large servicers. We represented HUD for a period of time, and we've been representing Fannie Mae since 2008, really when the last crisis hit. So we got our PhD in 2008, and then the market got a little bit worse and significantly better, and now we're back into uncharted territory again. But like you mentioned, I think it's better than what people thought, and I do think we're going to come out the other side better than the predictions.
Now, Dave, you're licensed in, I think you said, just about every state the east of the Mississippi, correct?
Correct. Correct.
And foreclosure's been something that you've been a big part of, like you said. So, and we were having some discussions prior to. So I'm really excited. We're going to dive right in. But let's first talk about what is forbearance. So for many of you that have heard that term but haven't actually applied for forbearance, it's where your loan servicer actually pauses your mortgage payments. And I think they're on a couple extensions on this right now. Many got it for 3 months and then 6 months. And I think now there's really a path to actually have your mortgage payments suspended for up to a year. One thing that you have to remember is that you must repay this amount. This isn't something that goes away. It does not erase what you owe in any way. And your normal interest continues to accrue. So options may vary from non-governmental backed loans, but the CARES Act that was implemented, actually, like I had mentioned earlier, expired yesterday or last night, but it was extended, and they extended it at least through December 31st of this year. What we're talking about are government-backed loans, or FHA, VA, USDA, and Fannie Mae and Freddie Mac. Now, a lot of you might be thinking, what are those acronyms? Well, if you are unsure of whether you have a government-backed loan, you would check with your loan servicer, whoever's at the heading of your statement. You would check with them to see whether you have a government-backed loan if you're unsure. Um, so, like I was saying, originally you could request it for up to 180 days. And with the CARES Act, there was no additional penalties or interest other than your regular interest, is continuing to accrue. The other thing that is really important is that in order to be eligible for forbearance, you have to go through financial hardship as a result of COVID 19. So there isn't a big criteria for doing that. You basically just have to tell your loan servicer that that's what's going on. There's no special documents that I know of or proof that you have to provide. But I do know that it has to result from COVID 19. Understand that when you repay this forbearance, that some servicers, and one of the updates to the CARES Act is that they don't want the servicer to hit you with a lump sum at the end. At first, they were saying if you extended and didn't pay your mortgage for 90 days, at the end of 90 days, you'd have this huge lump sum payment that you had to pay back. And they knew that wasn't going to work. That would be like almost immediate default. If you didn't have enough to pay mortgage payment 1, 2, or 3 into your forbearance, why would you all of a sudden have a huge lump of sum? So they have told the banks or the servicers that they have to work this out with you to best suit your needs. The questions are, when you're asking them, is how do you pay it back? Is it put at the end of the term? Can my loan be extended? Is there a modification? Will subsequent payments end up being higher after the forbearance to make up for it? So, guys, it's important that you beware scammers. You should not be speaking with anyone about your loan or forbearance unless it's your loan servicer. So if people are calling you up telling you they're going to help you or whatever that is, beware of that. Make sure you're talking to your loan servicer. Also, after this show, we will have in the show notes contact information to reach me, David, as well as the resources that we have for you that if you're experiencing trouble, for example, like consumerfinance.gov/coronavirus is one of the sites that you can go to. And also just the last minute tip is make sure that whatever forbearance you're getting, make sure you have it in writing. So I'd like to talk a little bit about, there's a website out there. It's the Mortgage Bankers Association website, or MBA.org. And it's where a lot of people go for resource to see what's happening in the banking world. And we're going to pull up a couple facts here on the screen. If you're watching this, you'll be able to see this. If not, we'll make it available for you. And I'm not going to read it verbatim, but I'll give you the gist of what it is. So basically, this was updated yesterday. All right. So very current information. So the latest forbearance and call volume survey revealed that a total number of loans now in forbearance remain unchanged relative to the prior week at 7.2%. Dave and I were talking. He thinks that even as of today, that's come down. And according to the Maryland Bankers Association estimate, 3.6 million homeowners right now are in forbearance plan. The shares breakdown of Fannie Mae and Freddie Mac loans in forbearance, they've dropped for the 12th week in a row to 4.88%, a 5 basis point improvement. Ginnie Mae loans in forbearance did increase by 4 basis points and is at one of the highest levels at 9.58%. The forbearance share for portfolio loans and private labeled securities increased by 7 basis points to 10.44%. And the percentage of loans in forbearance for depository servicers increased to 7.49%. And the percentage of loans in forbearance for independent mortgage bank servicers decreased to 7.41. As you can see, all within that 7% range, thereabouts. The share of loans in forbearance was unchanged as the decline in the share of GSE loans was offset by increases for Ginnie Mae and portfolio loans and PLS loans. They were at the higher levels. The pace of new forbearance requests has been relatively flat across all investor types, but for those with GSE loans, the rate of exits from forbearance regularly exceeds the new requests. Great news, right? MBA Senior Vice President and Chief Economist Mike Fratantoni, this is his quotes. The exception in these trends are borrowers with Ginnie Mae loans, as we just mentioned. The loss of enhanced unemployment insurance benefits, coupled with the consistently high rate of layoffs and the uncertainty about the job market, are having a disproportionate impact on FHA and VA borrowers. So let's talk about by stage. So 36.71 of total loans in forbearance are in initial forbearance plan stage, while 62.43%, which is the big bulk here, are in a forbearance extension. So about a little more than half are new to the game of forbearance. The remaining 0.86 are forbearance re-entries. So as far as weekly servicer call center volume, this is where you call up your servicer. The average percentage of servicing portfolio volume decreased from 8.7 to 7.2%, and the average speed to answer decreased from 2.8 minutes to 2.2 minutes. The abandonment rates decreased from 5.7 to 4.9%, and the average call length increased from 7.2 minutes to 7.7 minutes. And then here we go, the loans in forbearance as a share of servicing portfolio volume as of August 23rd, which was the week before, was 7.2% total. And basically, this survey that the Mortgage Bankers Association represents 75% of the first mortgage servicing market, or about 37.3 million loans. So not as bad as a lot of people were expecting. So we want to go to Dave here and talk about, Dave, when the pandemic first happened, when they first started shutting things down, you, me, and Mark, right? And I think that was it. I think it
Bob.
was, and Bob, right? And
Bob
Bob.
Flynn.
And so we all sat down. We called this emergency, and you can find this in a video on YouTube. It's still up, but we called for this emergency, like, podcast to talk about, like, oh my gosh, what's going to happen. And then the next day, Joe, who's kind of handling our content creating, and he's actually working in the office tonight, and he's putting this podcast together. The next day, he called in sick. So he said, oh man, I think I have a fever. I'm breaking out sweats. And I was like, oh no, this is like 6 o'clock in the morning. And I had to call these guys and be like, hey guys, by the way, Joe is out sick. And we were all just sitting in the office together in really close quarters, no social distancing, no masks, spitting all over each other. But anyway, so Dave, I'm really excited that we could have this follow up here almost 6 months later, and we're all doing much better. So give us some points of how we are in such good shape and things that have happened that have worked. And this is despite what side of the aisle you're on. We're not turning this into a political message, but there are some facts that we just know about. And Dave, just, why are things better than expected?
Well, a couple points, Todd. I think, first of all, great information you gave out. When people call me, I always say forbearance is not forgiveness, but the good news is they're not going to make you pay a lump sum when this is over. So this hardship has affected some industries and some areas of our economy and some areas of our country more so than others. I think we're in better shape than anybody thought because we're resilient. I think that small business owners that could shift gears and go to different products or go to different services or do certain things, cut expenses a certain way, they came out of this much better. I told you when we were talking today that, I got a friend that was importing high-level fabric to make suits and dresses, and he switched in April just to import fabric to make PPP and other garments that the healthcare industry would need. He's going to have his best year ever in 2020. So they're the kind of stories I think that, are why we're a great country. And I'm always optimistic on our country and on our people. So I think that's important. I told you the other story. I got a senior vice president at a regional bank here. They had 300 million commercial loans in forbearance in April, and they have 2 loans left. Less than 5 million out of 300 million are currently in forbearance. Everybody else is current and paid. So there are a lot of great signs. Obviously, travel, the restaurant owners are in really bad shape. Some of them, travel, really bad shape. Hotels, those types of things. But most of it, people were resilient and they got through it.
So it is interesting. I mean, it definitely, there are definite winners and losers in all of this. I mean, that is the sad part, that, as a result of everything that's happened, there definitely have been winners and losers. I mean, it is sad for our local business owners and local employers that are experiencing most of this hardship. One of the things, let's talk about, you had mentioned a number of foreclosures. So let's just advance a little bit about the foreclosure side of things, because we said that we didn't think it was going to be as bad. I know when we talked a couple weeks ago, you had said that, and even tonight you updated that number, that in 2008, 1.7%, I think it was, of the loans went into actual foreclosure.
Correct. And I think it got to 2. I think the highest it ever got, Todd, was about 2.3 or 2.4 in 09 and 10, but it was a different market then. I think that they were more, the credit was easier to get back then. I think a lot of those loans were B and C credit loans, whereas banks have been very strict with credit since 2010, and I think that's alleviating some of the problems. And I know from where I sit, I don't think we're going to come out of here. The foreclosure, there's been a moratorium on foreclosures now extended to December 31st. I know that Mnuchin in front of Congress today, and they were debating the next CARES Act package. I think the Democrats wanted it to be $3 trillion. I think the Republicans wanted $1 trillion. And of course, they'll most likely settle in the middle. They'll extend all the provisions, and then the devil will be in the details. Where did the $2 trillion go? And will it go to Main Street or will it go to Wall Street? And I think that's a misguided way to explain that problem. Everybody's dependent on Main Street and everybody's dependent on Wall Street, whether you think so or not. And, the business you're in, look at the supply chains that have been disrupted by COVID. Those companies need money to increase capacity, because if you're building a house, your lumber cost is up, 20% now? Because of the supply chain.
Yeah, it could be 30 or 40%.
Right. So we're all dependent. We're all interdependent because we have a global economy. So I think the media puts things out there that aren't quite explained and aren't quite accurate, and I think it's unfortunate.
So do you think foreclosures are going to top 08? 09?
I think we're going to be close, but I don't think we're going to get above 08 or 09. But I do think it's going to be close. Now, if you asked me that question a month ago, I thought we were going to be at 3%. But I really think, because of all the consumer protection laws that were put in 08, 09, and 010, and the better evaluation by the banks of the credit worthiness of the purchasers, I do think now that number's going to, I think it's going to probably be at the 08, 09 number. But, it's going to be interesting. I know we're going to maybe touch on this later. There's a great migration starting from the cities out to the counties for various reasons. And, will there be strategic defaults of those properties in the city if those values decline? That will be
Interesting.
interesting to see what comes of that.
Yeah. Well, we are going to get to that. And real quick, I do want to take a moment because we do have a couple questions that have come in, or actually a question and a statement. And maybe you have something that you can add to this. And by the way, guys, if you're watching us, we love to answer your questions or address your comments. This is interactive, and you're very important to us. And this is why we're doing this, is for you. So if you could ask your questions, we would love that. So Clark has asked from Facebook. He says, it seems like all forbearance will be added to the end of the loan, extending the loan terms. Your thoughts?
Maybe. I think the big issue that they're going to have is if someone misses 6 months or a year of payments, they have an escrow account that's short. So they may want to try to recapitalize your payment over a 2 or 3 year period just to make up for the escrows. That's a cash flow issue with the banks, unless the Treasury is going to say, we're going to give you money at 0%, and don't have to worry about the clerical function of doing that. So that'll be the one hurdle that'll have to get over. As far as extending the maturity date, they could just not extend the maturity date and make a balloon payment due at the end that has the payments. But I do think that there will be pressure from the White House, regardless of who gets elected, that the payments will be tacked on to the end, and we won't see a significant increase in anybody's monthly payment.
Yeah, and some of the other options that are on the table, but they have to qualify, is that they could refinance or rework that loan, so known as a loan modification. But again, these would have to be things that as a borrower, you would have to qualify for. But great question. We appreciate that. Christopher has said that a forbearance will hurt your credit score and your ability to refinance or purchase a new home. And he says to avoid it at all costs. Thoughts on that, Dave?
Well, they're not going to report if you're in forbearance of a government-sponsored loan, which is the vast majority. I think 7 out of 10 people have loans that are being underwritten or serviced by government, backed by a government entity. And as you said, it's FHA, VA, Fannie, Freddie, Ginnie. So those loans, they'll report to your credit that you were in forbearance, but they're not going to report you later delinquent. And then when your forbearance period ends, as long as you make those next 3 payments, they should not have any adverse effect on your credit, but you need to monitor that. And I do think that there'll be programs to allow you to purchase or refinance as long as you kept your word and made those 3 payments coming out of there. Remember, and this is a little different than what 0809 was. You can look at the 0809 issues differently. You can say, well, it was Wall Street's fault because they loosened up the credit restrictions, or you could say it was the White House's fault because they encouraged it based on certain policies that they implemented. You could say it's the consumer's fault because they took the risk. But this situation, this is something no one could have predicted. And it's something that unfortunately has been difficult, like you said, Todd, there have been winners and losers, and unfortunately a lot of people are feeling the pain with this. So I think from a consumer protection standpoint, in this new kinder, gentler America that we have, I do think these people will come out okay. But I would not be concerned about the credit issue at this point. Based on what I'm reading, you're going to probably be okay with that.
Yeah, and Christopher, we really appreciate that comment. And I think the important thing, and I'm not talking with you, but I think that some people might think that they will do this whether they need forbearance or not, to maybe bank some money or save some money. And I think that's not a good idea. So I think that, it's important to use the program that you need. And then at that point, the upside is at least having a forbearance on your credit report is better than having those delinquencies, being reported when you're going 1 times 30 or 60 or 90 days past due. So I think it's really balancing, the best of the current situation that you're dealt with, and that it is a real situation. And I think, like David just said, the difference between this and really '08 is that this is not a housing crisis. I think that's important to remember. This is a job crisis. This is where we were shut down. So we're talking about people that couldn't go to work. And I think that is why the government had to step up and really do what they did to inject the money into the hands of the people to try and lessen this impact. And again, we're not turning it into a political debate on whether you agree with things or didn't agree with it, but this was a really scary situation. And when you're shut down and you're not making the payments, or you're let go as a result of your company that you were working for going out of business or laying you off, whatever that reason is, and two people are, really responsible for the mortgage, and they're buying that way. Guys, I'm a real estate broker. I see it. We see that people are buying houses with very little to no money down, and they're getting, grants are available or seller concessions. So a lot of people, they're buying these houses with two incomes. So even one income has really thrown them off to where they can't make their mortgage insured or backed mortgage. And they do have the ability to take advantage of this really no penalty forbearance. So again, we appreciate your questions and your comments. If you keep them coming. Dave, let's talk about servicers, because a lot of times people don't really know what a servicer is.
Yeah, a servicer is really like a middleman, like a bookkeeper that's basically collecting your monthly check, paying your whatever bills you've escrowed for, and then paying the owner of the note the fees that they've earned, and they're keeping a fee to do that. So I think one of the things that's really frustrating, Todd, we lived through the '08, '09, 2010 market where there were a lot of short sales, and people really didn't understand why they couldn't get their servicer to help them, or they had a first with Bank of America and they had a second with Bank of America, and they couldn't negotiate the short sale because the second wouldn't budge. But what they didn't realize was Bank of America didn't own either note. And whatever hedge fund or whatever entity owned that second, the servicing provisions in that note did not allow the bank to adjust it. So you have to really understand the market. So you're making a payment to someone that really doesn't own the note. There's someone else that owns the note, and they really call the final shots, especially with the non-government backed loans. So if you're in the other 30 or 35% bucket where you have a loan that's really owned by a large hedge fund on Wall Street or a large financial service company, their servicing agreement will dictate how much of a discount they would take or how long they'll let you forbear before they foreclose. That's really a private contractual matter, and it can't be. The White House and Congress can influence those companies by, going into a room and putting an arm around them and telling them what they feel is right, but they really can't interfere in a private contract.
So with the servicers, kind of explain what happens when there is forbearance. We had spoke earlier, and you were talking about just shortly ago. You were talking about escrow, which covers the borrower's taxes and insurance, homeowners insurance. A lot of times, I think all the time that is actually escrowed because they want to make sure, if you don't pay your taxes, they take first position. So really, that's like, the highest level of lien is not paying your property tax. So the servicers want to make sure that they're collecting that from you, and a certain portion of your payment is actually going in escrow to cover that tax bill that's paid probably twice annually. And then there is your homeowner's insurance. So they want to make sure that you don't stop paying your homeowner's insurance, because if you do and something happens to your home, they're out. So they're collecting that money. So let's talk about what happens when someone goes into 3 or 6 months or a year of forbearance. Are the servicers picking up that check?
Yeah, they're obligated under the servicing agreement to pay the taxes and insurance, and they're obligated under the servicing agreement to satisfy any lien that would be superior to the mortgage that's recorded. So yes, And that's where I think the cash flow crunch will be. So it'll be interesting when people come out of modifications, do they change the monthly payment just to make up the escrows over a 2-year period or 3-year period? Or are they going to be able to get low interest or zero interest loans from the Treasury to make up for that deficit in cash flow? And I think there was a time, sometime in May, where the rates shot up a point in one day because the servicers got wind that they weren't going to be able to tap into the necessary funds to cover these deficits, and they weren't going to buy or service any more loans. And then, our Congress and the White House worked this out with them, and the rates came back down to a normal rate, but a normal market condition rate. But that's the interesting question. But yes, because they sign a contract that they're responsible to pay it.
So what happens if they can't? I mean, is there, when a servicer, is there a certain, well, first let's talk about where do servicers get their money? So where do they get the money to back this potential deficit?
Well, they're getting paid a percentage of the monthly payment to do that. So if everybody makes,
But obviously,
obviously
this
listen,
will exceed.
Well, and and they have financial models that say normally only 2% of the loans are in default or aren't paying. So, or 1.5% are in default and don't pay. So they build that in their price. And as long as the market doesn't have a crazy issue like we have now, it works out okay. But what's happening now is, as you said, it's the default rates normally, Todd, since 16, it's averaged a half of 1%. So figure even though we're saying 7% is good, it's 14 times higher than what it normally is. So yes, their financial model no longer works. So that money's got to come from somewhere. Can they go to the owner of the note and say, now you got to come up with the money somehow? I don't know, but it's either got to come from there or it's got to come from the Treasury. So, when you talk about Wall Street and Main Street and bank bailouts, you have to understand that the bank bailout may actually be helping you if you haven't paid your payment and your taxes are due. So it's a very delicate situation.
Do you think there will be winners and losers in the servicers?
No, because I don't think the government can let them fail. I think the housing market's too crucial to all parts of our economy, and we have a tremendous shortage. I mean, you probably know the numbers better than me, but we have a tremendous shortage of housing in the United States right now. We certainly have a terrific shortage of affordable housing. So to keep every component working and keep everybody at the table can only benefit everybody in the long run. So I don't think they'll fail. I think that like everyone else, they'll figure out how to get through it.
Yeah, well, I guess that's what I kind of mean by fail, that they'll get bailed out. Whether there will be a need for certain servicers or banks to get bailed out here, because if this goes on for 12 months or this type of, like you said, 14 times the normal rate of delinquency, and they're covering those costs, I mean, I don't know where the money's going to come from. But to get back to your point about middle housing, we are in a major crisis all over the U.S. And I can speak to Maryland. We just went over these numbers in a sales meeting when we were looking at July. Now we're in the process now of deciphering August numbers. But in July, when you compared year over year numbers all through the pandemic, we didn't drop at all. Our sales stayed at least the same as last year, or, which is a very good market, or increased in a lot of the local markets. We cover 9 primary local markets here in Maryland. So we're tracking those numbers. They're the big markets that really wrap DC and Baltimore. And again, I mean, the numbers were high. The difference was we've been operating with, in some cases, less than half the inventory that we had from year over year, just last year in 2019. And what that means is really that middle housing market. So that's even lower. So the available middle housing, the affordable housing, and there's tons of reasons, why we're not making more affordable housing because of regulations and things. And we've even spoken with Ben Carson who's the secretary of HUD. I had an opportunity to chat with him, and even he says we need to cut some of the red tape, but that's a different topic. But yeah, we're in a major housing crisis and of middle housing. And what that means is very stressful for buyers. And it's causing buyers to really pay a lot more for the house, which, now we're starting to see appraisal issues. So, and as this forbearance is being closely monitored and the uncharted waters of where we may be going with this as far as delinquencies or foreclosures, I see where that appraisal becomes even more critical. Because what happened in '08, and I was personally involved with this, was that the appraisals were whatever they needed to be. So at that point, I mean, we were running such a crazy muck that, especially in '05 and '06, that it was like, well, where does it need to be? And we had all kinds of different loans and arms, and things were exploding. And what happened was the banks, and a lot of these banks are no more, right? A lot of these investors, they're gone. I mean, we can look at Countrywide, huge company that's out of business. And as a result of the foreclosures, and a lot of it had to do with inflated housing prices. Then we had a sort of deflation in the housing market. And that coupled with the fact that you could not get out from underneath of your mortgage is when we saw people just walking away. And guys, back in '08, I can tell you, I know somebody who lived in their house for 10 years without making a mortgage payment. So when we talk about forbearance, we go back to the '08 crisis. And the reason was just like Dave had said. What happened was you had these second mortgages, these HELOCs, or whatever it was. And basically, in order for them to foreclose, number one, they had to find your loan. They had to find the original documentation because the documents were gone, right? They were in boxes somewhere. Somebody was adopting a bank that went in default. So they were getting all their loans. They had to look through all of it, find the documents. Then they had to actually go and find the second and ask them to forgive the second so that they could even foreclose on the loan. So we were talking about years of, disaster. And I think, Dave, there are a lot of, aren't there a lot of protections out there for the lender now to fast track that when we end up getting to the ones that will be foreclosed?
Yeah, well, I'll talk about locally here in Maryland. I think if you talk to most attorneys that do foreclosures, they're going to tell you it's going to take 9 months to a year to get a foreclosure through now because the policy changed in '08 or '09, maybe 2010 was when it changed, where there's a mandatory mediation for the consumer. There's an extra level of notices. But, Todd, it's going to be interesting as far as values holding. All the banks and all the financial service companies that bet there was not a housing bubble in '07, '08, '09 got murdered. But if you look at it here, because of the shortage of inventory, and the number I saw, you said half, and you're right. I mean, the number I saw on June 30th of 2019, there were 26,000 homes for sale in the state of Maryland. And this year on June 30th of 20, there was 12,000. So almost 40% of what it was. So the other thing too, I think is affordability. I don't remember what the rates were back in '08, '09 or whenever they received these. But like you said, most people took ARMs, but the rates were adjusting to 6, 7, 8%. Here people I think that are in forbearance still have a 3.5% mortgage. And people will be able to get, if you're in the market now, you can, I'm not a mortgage guy, but I'm seeing a lot of 2.75s on my note agreements for my settlement. So that house is just a much easier note, and it's a much easier monthly payment. So I think within reason, the values will hold. And I know on your side, you're seeing 10 offers on one house and escalation clauses and all these, but even if the value's up 10, 20, 30,000, because the rate's so cheap, I do think the value will hold. Now, if it gets much more than that, obviously, and you get a hardship, then that's going to cause some trouble.
Yeah, well, I can tell you in '06, I bought my home, and I think we were right at 6.5%, somewhere around there. It was not too far afterward. I was able to refinance for 4.5%, and I mean they, still good, uh, affordable financing options. I think, and we can talk about that for a minute before we get into the migration that you were talking about and the mass exodus of some of the major cities. Um, let's talk about where you think the rates are going to go. I have my opinion, but I'd like to hear yours. So, um, do you think? I know they say, you according to the Mortgage Bankers Association, they say they have to keep rates low. Do you agree with that, or do you see where they start to creep up?
Well, they're putting so much money into the system. I think the rates will stay low. Now, I can tell you, I was on a conference call with a very well respected economist last week. He's on the side that he thinks the 30-year rate will go below 2.5 next year. Now, I can tell you, Fannie Mae put out a prediction that they believe 2020 will close where the average 30-year mortgage was at 3.4%. That's because early in the year they were at 3.5 or 3.75. But they think next year's average mortgage rate will be 3%. So they think in 2021 that the rates will stay around 3. Depending on program and credit, you'll be at 2.75 maybe on the good side and 3.25 on the bad side, and they'll fluctuate some. If you watch the 10-year Treasury bill, they can't get that to move. The banks would love it to move so they could charge more, but they can't get it to move. And I know a lot of banks are rewriting their documents on these arms and these loans where they're putting a floor of 0 in because they were afraid that the actual Fed funds rate would go below 0, would go to negative. So I think for 2021, they'll stay very low. And I think, I look at it like this. It's a very unique time. We have a seller's market because there's low inventory. And we have a buyer's market because they have better buying power. So the negotiations will be interesting. But it's a very rare time that we could look a buyer in the face and look a seller in the face and say it's a great time to sell and it's a great time to buy. But I keep telling all my friends, you can get a 2.75% interest rate, you're going to regret not buying real estate in 5 or 10 years.
Oh, I agree with that. I just the question is, will we see, and that's the big question, will we see foreclosures? If we still see next year once forbearance goes away, if we still see where we get to '08, '09 numbers of 2% foreclosures, that will be an enormous amount of inventory that does hit the market. And then, of course, the question will be, will prices go down? I've been in this business long enough, over 30 years. I've been serving the residential and commercial industry in one aspect or another as a builder, a contractor, developer. And I can tell you that um, I think personally that we're going to see inventory, middle housing inventory coming on the market. I think it's a big race to produce more single family housing, affordable housing. But as far as interest rates, my prediction is I think you're right. I think in 21 we'll still stay low because we'll have to stimulate the market. We'll have to keep it going, and we will have to continue to absorb or at least make available the ability to purchase any defaulting property. I think that's going to be important, that we don't let it get to the point of '08, '09, where, at least in our area, I can speak to. I mean, I was buying houses that had been foreclosed on in, in really decent areas for 50, $60,000 a house. You can't touch that same shell for less than 130 now. So that was not that long ago. And the result was because the market was falling, the bottom was falling out so badly. So I do think that we will need to keep interest rates low, but I think we're almost at the bottom. And again, I don't have a crystal ball. I don't think that we'll go negative, and I don't think we'll get much lower than where we are right now. So I agree with you, Dave. I think that now is the time to buy. And I think more importantly is in the next 3 to 5 years, we'll see 5 to 6% interest rates again. That's my prediction. And I think the reason is going to be because we're going to need some cash in our banks. And the only way to get cash in the banks is to pay cash. So if you want investors to put their real money back into deposit accounts again, we're going to have to raise rates in order to have that happen. So again, just now real quick. So we have another comment from Clark from Facebook. He says, not sure we can survive another 08, 09. Won't be pretty. I agree. At least I don't want to see that. Just like I don't want to see another twin blizzard that we had in 2010. I would like to be retired before that happens and somewhere where it doesn't snow. And then also, Clark agrees that rates would be good next year in the 3s. So guys, cheap money right now. If you can buy, you need great representation. If you're looking for it, certainly you can reach out to me, Todd Sachs here at Sachs Realty, and Dave Thurston would be glad to give you legal advice on your real estate purchasing, help you title it, and help you get that thing closed. So we're going to make sure that you have all of our information. So now we're coming up on about 14 minutes or so. Let's turn, Dave, to what you had kind of snuck in there about migrations from cities. Number one, the landlords. I'm a landlord in Baltimore City. I have properties in the city, but think about the landlords in New York. Think about the landlords in LA, San Francisco, these cities of mass exodus. What happens with them, Dave?
Well, it's interesting. You know, Todd, I'm at a really interesting time in my life, and I have three sons. One is 29, one is 25, and one is 23. So because of that, I'm in touch with a lot of younger people, and I coached basketball for 25 years here locally. So I still talk to a lot of younger people. And so many of my former players went to school and then went to Wall Street, and they've been home for 6 months working out of their mom and dad's house. And a lot of these guys were spending $4,000 and $5,000, you know, with a group of guys, $4,000, $5,000, $6,000 a month in rent in certain cities, San Francisco, New York. They're not going back. I mean, they're able to work remotely. Their bosses are convinced they can work remotely. And what they're starting to do is look at a $250,000, $300,000 house in the Baltimore suburbs. So we've done so many first-time home buyer closings recently for kids that we've known. We had a great program set up for them. So I think that's one part of the migration. And I mean, obviously that is a COVID phenomenon because maybe upper management and HR in some of these areas didn't think they could handle business and serve clients and be profitable remotely. Now they figured it out, and they can. Maybe they're not as productive, but they're close enough, and now they can downside their commercial building. And then people, I want walkability. I want to live and walk to work. I want to walk to a restaurant. Well, you're not going to be working there anymore. You're not going to be going into that office. So I really worry. I look at Baltimore. It's got a small business district, but I really worry about its health over the next 10 years and how do you reinvent that? I mean, look at what happened to Harbor Place, and then does that problem grow out? Now, other areas off there are great little areas to be, but I see and for unfortunately for political reasons, I think that a lot of people look at the way government is conducted in those areas and safety and health issues, and they're coming to the suburbs. And it breaks my heart because I'm a city guy. I grew up close to the city and I'm down there all the time. But I think it's our reality. I think it's people are coming to the suburbs for a lot of reasons, and I think it's the perfect storm. I think it's expensive tax-wise down there. Just look at Baltimore, for example. Taxes are expensive. You don't feel safe, and now your employer doesn't need you there anymore.
Yeah. Well, and you talk about the businesses. I mean, think about, and this is all across the country, think about the absence of baseball and now the absence of football. I mean, we have the stadium in Baltimore and all the high rents around that stadium that these restaurants and bars and hoteliers or paying, for this top dollar real estate to be there, and then these people aren't there. So, how long does it take before you can rebuild that, or how much do you need to sustain, your expenses and things like that? And yeah, and I hear you. I mean, the city is expensive. One of the biggest things. I mean, I pay, in Baltimore City, I pay outrageous taxes. My very nice properties, properties that have been 100% renovated, every one of them, and lead's been abated in 100% of them, and and we see where the water bills, and this is a little off topic, but now water bills and sewer bills are combined. But now in Baltimore, they charge that every month. So now they're charging administrative fees. I've gone on to my properties and looked, I'm the only one on the whole street paying the water bill. I mean, you look at some of these properties, you have $25,000 water bills that they're behind in a house. So, and we have it to where per tenant in a house is anywhere from $30 to $50 a month water expense. So if you have two people or three people, you're looking at $90 to $150 a month water bill. So it's expensive. So when you're looking at the millennial buyers, it's funny because the National Association of Realtors published in 2019 that 40% of the buyers were millennials, first-time buyers in 2019. So when you're looking at these buyers, these younger people buying, they can't afford this kind of tax bill, or this kind of, it really does cripple their ability to be affordable. So what's happening is we are seeing now that people aren't, working in the office, or that they can work from home, that they are moving out into the suburbs, into rural America, for affordability reasons. But what happens now? Let's talk about what happens to that real estate.
It's an interesting question, because on the residential side, the prices will have to decline. On the commercial side, a lot of that space is very difficult to retool. If you got a 15-story building a block from Harbor Place and you're 30% rented or 25% rented, what do you retool that building to be? So it's going to be a big challenge. I would tell you, we talked a little bit about the banking and the balance sheets of the banks, and will the banks be bailed out? I can tell you, banks that have a large amount of loans extended to commercial buildings are nervous. And one executive told me, I think in May, 30 to 35% of their commercial building portfolio was in default. So,
And forbearance.
well,
Yeah.
well,
And forbearance or
technically,
default, or aesthetically the same thing.
yeah, because they don't have the protections that the consumers have. So, will they come out of it? I don't know. If you're a large company, we already became, unfortunately, because of our tax structure and our safety issues, we've already became a satellite company town, right? I think when I worked at Ernst & Young back in the late 80s, there was 25 Fortune 500 companies in Baltimore, and I think there's one or two left. And the one is fading fast. We won't mention any names, but so we become a satellite company town. And then this hit now is I worry about the business district, and I hope I'm wrong, but I'm really concerned about it.
Yeah, likewise. I've been in commercial real estate for quite some time. I invest in commercial. I own commercial real estate, and absolutely, it is a scary time depending on the sector. I think office buildings really will be repurposed. A lot of people aren't renewing their leases. We are actually leases, and the landlords are paying attention, because what are they going to do? So we're actually going in and asking for forbearance in lease, and also reduction in lease rent amounts. And the way we're looking at it is going in and saying, hey guys, look, if they go out of business or default, what's going to happen to your space? Number one, you're going to have to spend money in tenant improvements. Number two, how long is it going to sit vacant? You at least have somebody here, and maybe they've been a tenant for 10, 12, or 14 years. They're going through a hard time and they don't want to do anything. I mean, I understand, guys, that, we're all in this together and you have mortgage payments as well, but you really need to think smart through this. You need to talk to professionals like ourselves and see what your options are. So, um, Dave, parting thoughts?
We've covered a lot of information. Like you said, I'm here to help if anybody ever needs to talk to me. And I appreciate you having me on. And it's been an interesting 5 or 6 months, but watch unemployment rates. If unemployment rates continue to be they're still high traditionally, but if they're, the prediction was they'd be 20 to 25%, they're right around 10. If that number continues to get better, we get through this election hopefully and get some resolution on some things and come out of this thing strong, I think, in 2021. So hopefully get a cure and a vaccine, which I think everything's pointing to. We'll have a cure hopefully by Christmas, or a vaccine by Christmas. And if that happens, I think 2021 and 2022 could be great. And I really hope long term, we really take a hard look at our supply channels and our supply lines and bring manufacturing back. I don't need a tax cut for myself, but I would love to see the government put some type of incentives in to bring in manufacturing jobs back over here, pay people an honest living to do that instead of these third world countries where they're just enhancing the conditions over there and not helping them. And bring that back here so we can control the supply lines and control our own future. That's the one thing I worry about, and I hope COVID's taught us that we have to be more self-reliant in the future, and I hope we get back to that point.
Yeah, thank you. Thanks for that. And, I'd like to say, guys, we are of a great people and a great country, and we are resilient. And, we're all here together. We're all in this situation together. And it's never really been a more important time to support, like Davis said, our local businesses, our local owners. I think that we all do what we can and do our part, and we'll continue to do that. I think that we will see, it wasn't that long ago when I was a kid, and that things were stamped made in the USA, and that really meant something. It's been a long time since we've seen that. I'd love to see it again. I know that we certainly have here in Maryland and many parts of the country, we have great ports. We do have the ability to ship products. We do have the ability to make them. And maybe that's the best use for our cities, that we can actually turn our cities into manufacturing hubs. And that, at least like in the Port of Baltimore, that we can get products and goods out of Baltimore if we're making them there and ship them all over the country and world. And guys, as we wrap up here, I want to thank you so much for your time and watching this video. I also want to say again that all of our contact information, it will be in the show notes. David is a great resource. He is a trusted resource. He knows what he's doing. I've seen him firsthand help personal friends and clients, and he, he's great to reach out to. If you guys are looking, no matter where you're looking at seeing this video or audio, listening to this audio, I'm here for you as well. So I can help you all over the country. I am licensed here in Maryland to transact. If you live in Maryland and you're looking for buyer or seller or tenant representation of both commercial and residential real estate, we can help you directly. If you're in another state, I have a broker network all over the country. I am glad to pair you up with somebody that could help you if you just reach out to me. My email, everything will be below. You give us some time to update this video and put that in the show notes. And guys, thank you so much. God bless everybody and have a great night.
Thank you, Todd.
Thank you.